afternoon. This is Jim Barlow of OakTree Strategic Leverage. I hope everyone's had a great morning. Here we are on Thursday. Um, Inversion thinking, executive employee benefits, and Kaizen. Why the smartest companies design benefits by removing failure first. For those who have attended, I really think inversion thinking is essential. Looking for how I could lose. So let's get started. I've never done this presentation before. Executive employee benefits. I think it's going to be good. I hope it's helpful to you. So I decided to add a little bit so you know who I am. I'm Jim Barlow. I've lived in Clearfield, Utah almost all my life. My wife is Barbara. We've been blessed with 7 children, 28 grandchildren. Going to get a great grandchild in June. Exciting. Graduate from BYU. We remain devoted fans. I worked as an investment advisor for over 40 years. We love to travel. We visit loved ones. We enjoy family vacations. We read and attend plays. We love plays. We treasure time with the family. We serve in the temple. We strive to be disciples of Jesus Christ. Basically, I believe I'm trying to do good and helping others to have a better life. Anyway, you probably need to know a little bit about me. The picture is we do a family reunion every 2 years, and this was 2024. We're going to be meeting up at Bear Lake this summer, and we'll do a new picture. But there was the family 2 years ago. It's changed a little bit. We've got some more son-in-laws that will be added to the picture. So this inversion principle, most of us say, how do we succeed? What return am I going to get? Inversion asks, what could cause us to fail? What could cause this to fail? In business retention, avoiding loss matters more than chasing upside. How can we make sure we protect and keep our our employees? So what does this mean in the investment world? We don't ask how to win first. We ask, how do we avoid losing? And this is a new logo. I haven't actually put it on all locations, but this is my new tree logo in the bottom right corner. And the arrows, let's twist this question around. Let's think of this. Let's look at investing from a different point of view. Let's shatter the way we've done it, and let's look at the roots. Let's look at things upside down and see how can we avoid losing. Why executive leave? They don't leave for 3% more salary or one-time bonuses or extra PTO. What do they leave for? They leave because long-term wealth feels uncertain. Their financial future feels exposed. They don't feel structurally protected. Their wealth plan depends on markets. They're just unsure of the future. Retention failure is structural failure. You need to set up a structure, not just the stock market, a structure that protect the employees for their future. So the retention tools that are out there today, there's really 4 categories, 4 buckets: cash, retirement plans, equity, insurance-based plans. Let me review them with you. Cash. Most common, least sticky, bonuses, raises, spot incentives, instant reward, instant exit. It's not sticky. Someone who might pay a little bit more, they're gone. start here. It's what you're familiar with, but as weak as the retention anchor. You need to be competitive in this area. It's the foundation. Then we have retirement plans. Pretty standard, 401k, profit sharing, broad-based, not targeted, long-term savings, not loyal design. If the government regulates it, they can transfer their IRA to a new employer. So if it is good to offer a retirement plan, it's expected, but it probably doesn't retain people. So you're matching whatever, 3% on the first 3% or 4% or whatever. The other company might be doing a match too. So a standard benefit, you probably should have it. Equity, stronger, giving them stock options, restricted stock, phantom stock, real stock. Ownership alignment, vesting creates retention pressures, value tied to company performance. Equity can create stickiness for sure, but it introduces volatility, dilution, loss of control. But it is worth considering. I gave ownership in my business to my son-in-law, who eventually we did a buyout and he became the owner of the business. Equity ownership. The last is insurance-based plans. A structured retention. Executive bonus, section 162 was the actual area in the tax law. Bonuses, or a SERP as it's called, non-qualified deferred compensation. Used a lot. Split dollars, shared policy arrangements, where the employee and the employer is working together, putting money in, how much each are doing. Or a premium finance. I worked quite a bit of time. I didn't want to use the word premium finance, but some kind of a leverage insurance structure. These are retention structures. These will help. So here's the color code you saw. Number one is the number 4 we looked at. Structured. Number 1 is the green. Long-term tax efficient wealth. 2 is the equity. 3 is the supplemental retirement, or the 4 is the cash bonus. I actually reversed the order I presented them in the rank of real retention power or lifestyle perks. So why most retention plans fail? Why don't they keep people at the company? Short term, fully taxable, depends entirely on the market, lack vesting psychology, don't meaningfully increase net worth, they're replaceable elsewhere. Don't remove the downside. They haven't totally made them feel comfortable with their future. And, oh shoot, I forgot. I think about a third of the people, employees, don't participate in the 401k they have available. So it's not even covering in some of them everybody. Inversion thinking applied to benefits. Instead of asking, how do we reward performance? That's what you think of first. What would cause our key people to feel financially exposed? How can we make them feel better about their future? Example, market crashes, makes you feel unsafe. Taxes, longevity risk. Wow, how long am I going to live? Business concentration risk. Golden handcuffs that aren't strong enough. These are reasons they kind of leave. The unspoken fear. Executives rarely say this out loud. If I stay here 15 years, will my wealth truly be protected? Or they might say, am I one downturn away from resetting my retirement clock? 2008 reset the retirement clock to a lot of people. Their 401k did not protect them. It went down too. What truly sticky retention requires? Well, if you can remove the downside exposure, provide long-term accumulation, tied with that downside exposure, tax-efficient structure, create vesting alignment, build non-market dependent wealth, feels transformational. Of course, I didn't tell you a lot of details there, but the no downside, long-term accumulation, tax-efficient, making people feel better. Remove the downside, add leverage, compound time. Well, what if you could do no downside, zero floor, long-term compounding, even with a zero floor, bank leverage? Can we borrow and not have greater risk? Give some time, the 10 to 15 year horizon. So this might help, kind of a golden handcuffs. Employer design flexibility. Well, Kaizen is the structured leverage design that addresses these failure points. The employer contributes for the first 5 years. 5 years. That's it. After 5 years with an employee, they can decide, well, Mr. Employee, let me do it for you again. Another 5 years. Bank leverage multiplies capital. Index growth with a floor, no downside. 50 with the borrowing, we have a 15-year target bank exit. A long-term accumulation with no downside, creditor protection, tax advantage, potential tax-free access. That's kind of the nutshell. I want to give you more. What failure does this remove? Market collapse, underfunded risk, because the leverage is helping, a tax drag, paying taxes, short-termism. I guess it's a disadvantage of being long-term, but it's long-term that people really want to make sure they're ready. Weak vesting. So why this change in behavior? Executive structured wealth, defined timeline, downside protection, growing asset base. Sounds good. Think long-term. Long-term thinkers stay. That's retention. I've got Kaizen. I really can't spend hours in a webinar telling you all about it, but I've got the basics of Kaizen into 3 categories: the foundation, the growth, and the control. This is all the bullet points of Kaizen. I'm going to quickly show them to you. First, the foundation, remove risk that breaks financial plans. The basic structure is going to be a life insurance policy. So immediately they have life insurance protection. And they have the policies we use, the companies we use, have living benefits. disability coverage, accident or injury, long-term care income coverage. So it's all the protections, the legacy and living benefits. Protects today and legacy tomorrow. That's the foundation structure. Tax-free growth and access. Money in a life insurance policy, I'll use the term gross tax deferred. Probably saying growth tax-free is a little bit misleading. Maybe I should change that. Tax deferred. When someone passes away with life insurance with some cash value in it, it goes to the heirs tax-free. And as the owner of the policy, you can borrow from the policy and not pay taxes. So that's the tax-free. Pull out a retirement plan tax-free. No management or advisory fees. This is the life insurance world. You're not paying an advisor fee. I charge 1% a year with my clients and an investment advisor. That's gone. If you're using a mutual fund, there's internal management fees. That's gone too. So there's no management fees or advisory fees. There is life insurance fees, which all the benefits, I'm going to show you in an illustration, all these benefits overcome the cost of insurance. This is the foundation. There they are. Tax, legacy, living benefits, tax-free, no advisory fees or management fees. Then we have the growth part. Participating in growth without exposing capital to loss. Downside protection, no market losses, market-linked growth, upside participation with zero downside risk. That's all there is to this growth, but I want to show you how they do this. The majority of your cash value premium goes into the general account of the life insurance company, which is consistent of high-grade bonds. A very small portion goes to an option budget. So we got $1,000 available to go into the cash value of a policy. But in a 5% interest rate market, about 952, we're going to the general account. We know that that will grow in 1 year to back to 1,000. So we protected the downside, and we take $48, the amount for the option budget, buy options in the market, SP 500 or different mutual funds. That's how you can have market returns without downside. I really pretty cool concept. That's why you pick this structure of life insurance. Okay, the last area, this is where the founders of Kaizen is doing a bit of work. We have institutional leverage. We're borrowing about 3 to 1. If you're putting in 100,000 over 5 years, we're getting a bank to put in 300,000. And you're going to make money on people's money. Greater growth, less personal capital. 5-year funding, that's it. It's finite, predictable. We set it up in a trust ownership. This gives structural protection and creditor protection. And the master trust is doing the borrowing, doing all the work behind the scenes so that you don't have to. This all makes it very turnkey. Minimum management with no downside options. You can leave it in the investment options, the index choices forever, really. but you can be be a little more aggressive per se by doing some movement. But basically, you don't have to. It's a turnkey design. Don't worry. Liquidity and flexibility. We need some time. We have the 5 years of you contributing. We actually have the bank contributing through 10 years. We need some growth time. But after this initial runway, you have greater access to liquidity and flexibility. There's no requirement minimum distribution rules attached to this. So there's the 5 basic areas: structure control that the founders put into Kaizen. Here's a visual. The silver pigs is your 5 annual payments into Kaizen, or we have one vendor that we can do monthly payments for 5 years into Kaizen. The gold piggies are represents the bank contribution. They're approximately putting in what you're putting in for the first 5 years, matching them close, not quite. And then the next 5 years, they are taking on your payment you were paying and continuing what they're paying through 10 years. That's how the money goes in, approximately 3 to 1. All without the typical risk of borrowing. There's no credit checks. There's no loan documents. There's no personal guarantees. There's no signature on a loan that you're borrowing money. There's no collateral you're putting up, where in premium finance, strictly, you do put up collateral. And when you buy and borrow, when you buy real estate, when you use leverage and borrow money, the property is the collateral. So in most cases, you have to use collateral. There's none here. We have some tools. One of the ones that I use every day, the founders of Kaizen built this website called ILIA. The top left, Interactive Learning Information Assistant. It has lots of resources. There's an index on the left. One of them, estimate my benefits. And that's what I want to start with. I want to give you a hypothetical insured person. 46 years old, male, excellent health, putting in $70,000 a year for 5 years. Then beginning a distribution at age 65, and making sure it happens through 90 for sure. We're going to use an illustration rate of 6.81. This is a regulated rate by the NAIC, National Association of Insurance Commissioners. This is an association of states, state insurance commissioners. The insurance is not regulated by the federal government. It's regulated individual states, and this association gives some level playing field per se. So we're going to use 6.81. It changes so often. This was January 24th, right? We're going to use a capital gain rate of 20%, income tax rate of 37%. We're going to assume an asset management fee of 0.5. Why did I choose 46 and 70,000? Because that's the average age of a Kaizen buyer nationwide, and the 70,000 is the average amount people put in. This 46-year-old putting in for 5 years. The minimums are about 20, depending on the person's age. Could be a little bit more. The maximum, there is no maximum. Whatever you can put aside for the future. Anyway, this is our hypothetical. We're going to show you the numbers. If I got that 6.81% in a regular investment account, an after-tax investment account, paid the taxes as we went, we could pull out, starting at age 65, $58,642. And through age 90, we'd have pulled $1,528,424. Now, I wanted to give this example person here this as much income as I could. I used every penny at the 6.81%. So at age 91, there's no income. I used everything to pay 65 through 90 at 6.81. The illustration software can change that to 95, 100, 60, whatever you want. But I think 90 is a good number. That's what the company usually recommends. Now, if we do that in an IRA, a 401k, we'll have more money. We'll have 74,106 starting at 65. That's better. In my alchemy webinars, I used to say that's a little bit of alchemy. We'll have 1,926 total income from there. So, drum roll, please. The next line I'm going to show you is Kaizen. For this 46-year-old person getting the same 6.81, can Kaizen with the advantages it have, no downside, no advisory fees, tax-free, can they get more income at 65? What do you think? 84? 94? Well, drum roll, please. 130,000. That's quite a bit more, actually with lower risk. And at age 45, we started out with $2 million in life insurance. Day one, pulled out $3,380,000. And at age 90, there's still a death benefit, which also means there's still money to withdraw from. You could keep withdrawing this money, 130,000 a year, probably for an endless amount of years, a lot of years beyond 90. That's the Kaizen. Now, that's pretty good looking. We do some stress testing. We stress test this strategy to see how it worked. In the Great Depression, if we bought Kaizen in this era, well, we're going to show in our stress test, we're going to do 9 years of zero return. Notice no negative years, but we're going to have 9 years of zero returns over 12 years. Will this still look okay? And then the other stress test is the 1980s, the highest interest rate environment we've ever had in our country. Many of you have experienced that. I did. And the loan interest rate reached 16.88. Does this work in a high interest rate environment? Well, let's show you. Kaizen was stress tested in both of these, and here's the numbers. The Great Depression, instead of 130, the bad economic time, it'd be 84,500. Still higher than 74 or 58. In the worst time, and those would have been lower too in these times. And the 1980s, 97,000. So high interest rates are not that as harmful to Kaizen. Wow. Got another drum roll. What drum roll could I possibly be doing now? What I'm going to do, Allianz, one of our insurance companies we work with, actually the world's largest insurance company, they want to say this illustration software you invented and built, we want to make sure it's not lying to the people. So we're going to analyze it, and we'll tell you our finding. Well, their finding was there's an 80% chance that 130 is going to be double. Whew. Not 130,000, 80% chance there's going to be 260,000. Now we have the full range. We have the comparative ones of 58 and 74, but we got the lowest in the Great Depression, 84. The illustration is 6.81, 130,000, or maybe the double. Wow. That's why I like Kaizen. Oh, I forgot to tell you what I was doing. Okay, this right here, this is the male, age 46, excellent health. What if you're female at 46? Well, the Kaizen went from 130 to 133. Women live a little longer. For you who are listening, it's a better situation. And your double is going to be more. So not a whole lot more, but a little bit more. It's good to know. And I got another one. What if this male was just average health? Well, instead of 130,000, because the higher cost of insurance, it'd be 120,000 Kaizen. Still very competitive. Still, a double would be about 240. Even if you're average health, Kaizen gonna beat. Can you have lower than average? Probably not. You need to really have average or excellent for them to accept the risk. I apologize for those who are not insurable that can't have Kaizen. So how's it done? The very first policy issued was 2012 to one of the founders of Kaizen, one of the owners, and they allow me to show you her numbers. There's an annual statement. The most recent one was June 27th, 2025. From day one in 2012, she's averaged 7.85. And the average market investor in the same period of time, as my guesstimate, would be about 7. So is it 7.85? Yes. Competitive. Is it competitive against you picking the best stock there is? No. But we're reducing risk, giving a solid return. One that actually most investors don't even get. The average interest paid from day one is 3.95. And there's something we call the spread. You take the return, 7.85, subtract 3.95. The spread, she has made 3.9% on the borrowed money. Remember the three times what she invested. And so she's made money on other people's money, the borrowed money, 3.9. So her money, 7.85, the borrowed money, 3.9. We did another back testing they did. They back tested this in 1930. There's never been a 15-year period of time with less than a 2% spread. Now, is there a 10-year with less than 2? Yes. Is there a 1 year for sure? -0. Never a 15-year. As long as you're a long-term investor, you can plan on probably 2% to up to 3.9. Maybe the spread will be higher in the future. 2 to 4. That is one of the beauties of Kaizen here. There's the first policy they're issued. So some tools for you. We have 2 new landing pages. This landing page has chapters, it has videos, it has a lot of information to help you go step by step to understand all the details of Kaizen. On your own, you can learn. You don't have to have a login. You don't have to give me your phone number, your email, your Social Security number, your anything, this is just available. There's a QR code to go to this landing page. You'll find it hopefully fun as you learn the details about Kaizen. The second landing page is a specialized Kaizen landing page for those who are considering buying Kaizen as a gift for their child or their grandchildren. So it's very similar. Well, there's different videos, but similar information, but a little different angle. It's the person who's gifting this to somebody, the child or their grandchildren. So there's the first two websites that you don't have to have a login. They're just there for you to use. If you take a screenshot. Here's a little bit. This is from the company that founded Kaizen is NIW, out of Plano, Texas. Kaizen is a Japanese word that means continuous improvement. I like the name. And their buzz line, the founders, they use more money, more protection, more confidence. We want a way to get more income. We want to have it protected, more protection, and we want to have more confidence people have in their future. I have a solid, good website. The top there, I'm showing you some of the quick links I have on my website. Different information that's available to you. You can go and quick link it. I also have a retirement income calculator that I built on my website. Very easy to work. It will help you decide what is my retirement income gap. How much am I short? And I've got a basic version. I have a more complex version with everything included. That's just for your use as you go to my website. Again, you don't have to log into this. You could. I don't know that you're using it. Anyone can use it. So I already showed you the ILIA, but so it's just. Well, that's probably redundant. I'll take that one out. How do you want to implement Kaizen? How can you engage in these choices? Well, one, with those links, with those landing pages, you can do this on your own. You don't have to have me trying to sell you. You can learn at your own pace, digital engagement. If you have questions and not quite understanding something, I'm here to help. But you can actually, like it's an Amazon account, just keep pushing buttons and understanding it and then purchase it online. It's the the Amazon version, if you want to call it. And you can ask for help whenever you have an issue you can't figure out. Or you can just do it the traditional way. You want to sit down and we'll go to lunch, dinner, or whatever. We can talk about it and show it to you and give you all the details. Whichever way you want to do it. You can do it on your own or you can ask me to help totally. It's the same strategy, just different engagement styles, however you want to do it. Now, let me put this all up. I've got these webinars that I'm building. I presented the Inversion Thinking and Kaizen. I presented the retirement income one. I presented the family gifting. And today is the first one of the executive employee benefits. And I've got the next webinar ready, the business succession. I'll show you the date on the next slide, I think. And ones I haven't built yet is the specialized ones, the inversion thinking and leverage, inversion thinking, market volatility, and taxes. But this will be my suite of webinars. I plan to do the first 3 monthly, executive benefits and business succession every other month, and those bottom 3 quarterly. So here we are on February 26th, doing the employee retention. And there's the one coming up on March 4th. It's the flagship, Inversion Thinking and Kaizen. Then on March 12th, we have the one on retirement. Then we have the family gifting one. Then we have the business succession, the brand new one that we have. I've prepared it. I'm ready with it. Just haven't presented it yet. And then we start over in April. We'll start again with the basic one, the flagship. Let me go back to make sure everyone had a chance to do a screenshot if you want to take those codes to log in and register. There's the first one. And there's the second one. That's probably enough time for a screenshot. I hope so. So, inversion summary. Most companies design benefits to reward performance. The smartest companies design benefits to remove financial failure. When you remove failure, loyalty compounds. Employers like it because it's flexible design, performance alignment, vesting control, talent differentiation, non-dilutive, and structural retention. If you want to explore it for executive retention, a wealth transfer, supplemental retirement, or strategic leverage model, let's have a structured first conversation, or go online and just work through it yourself. So after 35 years in this business, or 40, I think I said earlier, I've learned to separate products from structures. Most financial tools are just products. A few are structural. When someone has a runway, that has the runway, the health to qualify, they have the time to build it up. I've yet to see a more efficient long-term structure. This is as close to a plan that's going to work that anything can. And compliance will allow me to even come close to saying that. I love it. I think this is something that a lot of people should use to be prepared for retirement or other purposes. Anyway, there I am. That's showing the flagship webinar. There's my office phone number. There's my email. There's my website. And there's the QR code for the basic learning with landing page. Anyway, that's it for today. 12:44. Shoot, I would like to get this down to a half hour, all of them, all the webinars, but I guess I haven't succeeded yet. I hope you've enjoyed being with us today. As you have any questions, give me a call, text me, email me, your choice. Happy to helping you decide how you can approach your employees or however you want to potentially look at Kaizen. Have a great day. Talk to you again for when you attend another one. Bye.